nobody is looking 18 months out, right? Everybody's worrying about what's happening today, what's happening next month, how do we make money this quarter? It's hard to be patient, but suddenly uranium went from 20 to 120. Then that was the same in silver, right?
So ultimately, where are we in the cycle? And let's close off on your mining clock. What is that, and how do you read that?
Yeah, I think the mining clock is...
Another day of extreme volatility on Tuesday, March 3rd. The Dow's tumbling 250 points on the back of Iran's conflict. That's escalating. The gold price, interestingly, is also down about 4%. We'll talk about that. We'll talk about the future of gold, silver, and commodities with our next guest, Bob Thompson, Senior Portfolio Manager at Raymond James. Is this the top of the cycle? We'll find out with Bob, who's measuring cycles very closely, and he's made a number of very correct calls in the past with me. This episode is brought to you by Kalshi. It's a fully regulated platform that lets you trade on real-world events from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here, and you'll get, new users will get $10 deposited when you trade $10 on sign up. Traders can put money on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. More on that later. Bob, welcome to the show. Good to see you.
Hey, great to see you again, David. I think we first talked 7 or 8 years ago. So good. We'll review a little bit about what we talked about then. It's good to talk to you.
Absolutely. You made a number of correct calls in the last couple of years since we've started working together, including calling for higher mining share prices, higher uranium, higher gold and silver. All these things have come to fruition, and the timeline varies depending on, when you've talked about it. But generally, you've called the direction perfectly. You want to get your take on what's next. I'm here in Toronto. As you can see, the audience can see the background is different from my usual audience. And so, usual background rather. And so the PDAC is the world's largest mining conference. People have used sentiment at this conference as a gauge for sentiment overall in the mining sector. One of the pieces of feedback I've gotten, especially online, I read people's posts on Twitter and other social media about how they feel, is that this year being so highly attended, this conference, and so populated by what people would call tourists in the space, newcomers in this mining space, new investors from the retail side that may not have been here before or may not stick around. They're called tourists. That may signal a market top. The fact that it's probably the most attended PDAC ever, that to some people is a market top indicator. How would you respond to that?
I'm all about sentiment. I really am. I pay a lot of attention to sentiment because you usually want to be on the other side of the boat from where everybody else is. This is an interesting one, though. As you said, PDACs, a lot of people going to PDAC. A lot of people seem to be interested, but, I don't know any generalists that have any money in the resource sector. I talked to hedge funds here in Vancouver who do marketing, resource hedge funds, and they said they've never had more meetings with generalists about maybe investing in their fund. And I said, well, how much money have you got? They said, nothing. Everybody's kicking the tires, but they haven't invested anything yet. So, it's an interesting scenario. So to me, that doesn't sound like a market top. I know the sentiment's great at PDAC and the sentiment's great in the sector, but I just don't see generalists investing. And, Goldman Sachs recently did a survey to their ultra high net worth clients, over $100 million accounts. And they found that the average allocation in those accounts was 0.2% to gold. So it's just people aren't there yet. And I think one of the reasons for it is too much other action in stocks, right? There's AI stocks, there's other tech stocks, there's the Mag 7, and those are still sucking in a lot of capital. And we have to get this rotation, and that's what happened back in 2000 to 2002. You got the rotation out of tech stocks when they started to collapse into resources, and then it lasted for a few years. I don't think that rotation's happened yet. Maybe people have, put their foot in the water to see how warm it was, but nobody's really jumped in yet. And so it's an interesting scenario. 2.5% of the S&P 500 is energy, and that's at an all-time low. So it's telling you that people aren't investing in energy stocks. There hasn't been a rotation. So I'm still pretty excited about things going forward, but I'm always wary of sentiment, as you said.
The generalist hasn't come into the space yet, but the GDX, which is a VanEck Gold Miners ETF, is up 164% since last year. So who's been in the space? Who's been driving that up?
It's fascinating is up until 4 or 5 months ago, GDX was in net redemption. So it was going up in value, but the number of units was being redeemed. So most people were taking that as an opportunity. So I don't even know how that's mathematically possible that it could go up that much, and the number of shares goes down. But it happened. Some money started to come in the last few months, but not a lot. Now, this is interesting. Probably the biggest precious metals hedge fund here in Canada. Sorry, not a hedge fund. Precious metals mutual fund, and the best performing over 25 years here in Canada was in net redemption all of last year. Every month last year, net redemption. Every time he went up, and he was up 150% or whatever the index was up. Net redemption every single month, and it's crazy that people just don't believe in this. I don't know whether they're taking profits and buying more Nvidia or buying more Mag 7 stocks or whatever the case is, but the money doesn't seem to be coming into the sector a lot.
Bob, the fact that it's gone up this much, the GDX, what does that mean for the entire mining sector? Now, individual mining stocks have also done quite well. So it's not a case of just people are piling into ETFs and funds. Can you say the same for individual equities as well? Have investors looked at individual stocks with as much enthusiasm as they have with the index, you think?
Right. I think the easy money is always made at the beginning of the cycle. And, with GDX and, SILJ, which was the junior silver RTX. I mean, we were heavily buying it back in February of 2024, and it was $8 at that time. It's 35 today. So I think that, the easy money gets made at the beginning of the cycle. And from here on in, I think it's going to be a lot more stock picking. Got to be a good stock picker, pick the best projects that are going to come to fruition, that are going to start mining, whatever the case is. And I think that's the case in most sectors. I mean, we were talking uranium a few years ago. Cameco was $10 or $12. It's 170 today in Canadian dollars. I mean, that's a 12 bagger. And I don't know how much more do stocks go up. Is it going to go, if it goes another double, that's 24 times from the bottom. It could happen. But I think a lot of the easy money's been made, and now you're gonna have to be a good stock picker. So, but you bring up a great point, David, about some of the individual stocks going up. A lot of your audience probably has never heard of the TSX Venture, right? The TSX Venture here in Canada is a small index that nobody pays attention to. Even the generalists don't pay attention to it. It's a legitimate venture capital market of the Toronto Stock Exchange. It was up over 60 last year, but it's still down 65% from its high in 2007. So only a little bit of capital has to come into that market to make these things kind of explode on the upside. So volumes are picking up because volumes were very, very low. When volumes are low, nobody cares. It doesn't take much for stocks to go up. So we've had some good runs in these stocks, but I think 3,200 back in 2007, it's barely over 1,000 right now. So it's still down 65%. That means there's some good room here. And Toronto in general, we can talk about this more later on, but the S&P 500 has had a good run. I think it's time for Canada for the next few years. And few people, pinpoint this number here. In 2007, the TSX and the Dow were the same level. In 2007. In 2011, the TSX was about 20% higher than the Dow. Today the Dow is at 50,000, the TSX is at 32. So, everything in the market shows reversion of the mean. And I love when things, get out of whack by 2 or 3 or 4 standard deviations from the norm, because usually you just have to take a position in whatever, in the opposite of whatever that, anomaly is. And then you just wait and you be patient. And, I think it's pretty easy in the world these days to actually do better than most people. It's just a time horizon. But yeah, I see your chart up here. You go back, I think, to 2007.
Let's do it. 2007. Dow's up 305%. TSX is up about 189%.
Right. So, and you see in 2007, they were the same, right?
Yeah, that's
and then
right.
you see in
this is based to 2000.
Yeah, and then 2011 it was higher, right? The TSX. So, these cycles tend to go on for a decade. If we were talking in 2000 right now, the chart would look very, very similar to what we see right now. And if you recall, in 2000, everybody was running into the tech stocks, and from the high in 2000, the S&P did nothing for 12 years. 12 years of zero returns from
Just
2000 to 2012.
stepping away from mining for just a minute, do you think looking at this chart, it indicates anything to you about economic growth disparities between the US and Canada since 2007?
I think so. That's part of it, but the other part is valuation, right? You look at the U.S. market, and it's valued for perfection right now. So it's in the top 1% of its valuation throughout the last 100 years. I don't think that gives a lot of upside. I like to invest in things where you know what the secret to happiness is, David? Low expectations. Right. So you'll always be happy if your expectations are low. Expectations of Canada were very, very low over the last couple of years, and the Canadian market has started to severely outperform the U.S. market.
Bob, you told me offline that the single most important variable to look at when evaluating the future of the mining and perhaps even just commodity sectors overall is the U.S. dollar. So tell us about the dollar. What's next?
Yeah, and I think that's for any markets, not just commodities. Sure. And here in Canada, people say, "Oh, well, that means the Canadian dollar is going to go up versus the U.S." And I say, "No, I'm not talking Canada, U.S. I'm talking the U.S. against a basket of currencies, right? The Japanese yen, the Canadian dollar, the British pound, the euro, the Chinese yuan, etc." So the DXY peaked back in, again, 1999, 2000, pretty similar to the levels that it was a year or two ago. Then we had, everybody was invested in the U.S. dollar. Nobody wanted gold. Central banks had sold a lot of their gold. They basically held U.S. dollars as their reserves. And then the next 10 or 12 years, the U.S. dollar declined fairly substantially versus all these other currencies, and commodities went up. But everything went up. I mean, the international markets did better than the U.S. When the U.S. dollar is going down, the U.S. market doesn't do that well. So non-U.S. tends to do well, but especially in commodities. And I think it's important for people to realize it isn't an accident that commodities go up when the dollar goes down. I mean, if you think of an ounce of gold as the unit of currency, right, then the U.S. dollar actually goes up or down in relation to an ounce of gold. So an ounce of gold is worth $1,000, for example, right? But so if gold goes to 2,000, that doesn't mean the gold's gone up. It just means the dollar's gone down. So, and same with oil, same with copper, because they're priced in U.S. dollars. So when the U.S. dollar goes down, the commodities go up in price in U.S. dollars, right? Just makes sense.
Would you be long any other currencies versus the dollar then?
Yeah, I mean, I'm not a currency trader, but I love currencies that are kind of beaten up outside their norm and universally hated. If I can find something that everybody is on one side of the boat, hate or love, then you go to the other side of the boat pretty quickly. So I think there was the carry trade in Japan. There's Japanese rates have gone up, and obviously that's helped the yen. There's lots of factors out there that are showing that we've kind of reached peak U.S. dollar love, right? Central banks are starting to sell their U.S. dollars. There's geopolitical reasons for that, but the other thing is, when the U.S. can seize your currency or seize your assets if they're held in U.S. dollars, people say, "Oh well, what if they don't like us one day? Maybe we should diversify." So that's all part of this trade, and that's why gold did well. It's usually the first out of the gate, right? Gold did well in 2022, 2023. It started to do well, but the stocks didn't do anything, and you know why? It's because central banks were buying gold, right? And they were pushing up demand. But central banks don't buy gold stocks, right? They're not going to buy Newmont or Agnico in their central bank reserves. They're going to buy gold. So central banks were buying gold, and Western investors are the ones that buy gold stocks. And Western investors were saying, "Well, we don't know why gold is going up, so we're certainly not buying the stocks. This must be a short-term phenomenon." And then everybody was talking about that through 2024. And then, that's where you get positive on gold stocks, because that's going to revert to the mean. And here we are. We've reverted to the mean, and now they're up dramatically from here.
Well, let's just talk about short-term price action. There's massive volatility today on the 3rd of March. Gold is down 4%. The stock markets in the U.S., actually all around the world, are down. The Dow closed with 400 points, falling as much as 1,200 points at one point intraday. Bitcoin is down. The dollar is slightly up. The point is, there's a lot of volatility from the conflict in Iran that is escalating, not de-escalating as we speak. Why is gold down, though? Shouldn't this be a safe haven?
Right. I think it was overbought. I mean, yeah, not overbought long in the long run, but in the short run, it was overbought. Silver was down dramatically too. But I think it was overbought, but it was also because the U.S. dollar was up 0.75% today, DXY. So it's U.S. dollar goes up, gold and silver go down. But I should say, you mentioned Bitcoin, and we've been talking about this in gold and silver in a while, and it kind of gets wrapped into Bitcoin too. Unfortunately, in the short run, I think the financialization of any commodity is a bad thing for it. In other words, if you wanted to buy gold and the only way you could buy gold was to buy an ounce of gold, the market would be pretty stable, right? The supply and demand would fit itself up. But once you start to say, okay, now you can buy futures, now you can buy puts, now you can buy calls, now you can use leverage, now you can do ETFs, that increases the volatility dramatically, and it really causes the underlying market to dislodge from fundamentals in the short run. And that happened with Bitcoin, right? Bitcoin was doing what it was doing, and then they started with futures, they started with calls. Now you can do wraps and collars and all this thing on Bitcoin. And what happens? The price gets crushed, the price gets pushed up, and it's all to make some hedge fund money. That's what it's for. I mean, you've heard about this in silver recently, that some of the big hedge funds are buying a lot of silver on the market, and they're buying huge amount of silver ETFs. Well, what you don't see on the other side is that they're leveraging themselves massively in put options. So you knock down the price of silver. So, well, your nominal, your exposure through your put options is far greater than your ETF exposure. So you smash down the price, scares everybody out. You make millions and millions of dollars on your put options, way more than you lost on your long position. And all of that is, I don't know how it happens, but it happens. So you can get big enough that you can create your own market and make the market do things that you want it to do. And I think that's what happens in gold, silver. It happens in a lot of these things. I don't worry too much about it, because that doesn't matter in the midterm. But in the short run, sure. If you're running a pod shop and you want to make money every week, sure. It's a way for you to do it. So I really do think, and I know you've talked a lot about technology in the past, and I really do think it's become easier to outperform now than it used to be, which is crazy to say, because with AI, everybody's competing with AI, and information comes faster and can be acted upon, and all these sort of things that the human brain can't comprehend. But I think that's made it easier to outperform, and here's the reason why. Because nobody is looking 18 months out, right? Everybody's worrying about what's happening today, what's happening next month, how do we make money this quarter? And if you simply say, like we did, back in 2020, when uranium was $20 and it cost $60 to get out of the ground, we said in 2 years from now, I think that's going to change. And I think either uranium has to go up a lot in price, or the companies are going to go bankrupt. Well, you just waited on it. It's hard to be patient, but suddenly uranium went from 20 to 120, right? It's come back to around 80 now. So then that was the same in silver, right? So these companies, their cost of production was greater than the price of silver. Here's what's happened to silver. And I think that sector that is probably they're going to show that in the next couple of years is the energy sector. I'm not just saying that because of Iran. We've been talking about that for a few months. This Iranian situation is just a bunch of tourists who are going to come in and push up the price, and unfortunately, then they're going to get out, and the prices are going to go down. But I think the fundamentals for gas and for oil are very, very good, and especially where the stocks are positioned, et cetera. So.
Why does Iran have a long-term impact on the price of oil, you think?
Well, supply, we have enough oil in the world. We have enough copper. copper in the world. It's just at what price and how do you get it out of the ground, right? With oil, there's enough oil. If oil was $500 a barrel, they'd find enough oil to supply that. That's the great thing about commodities is the cure for high prices is high prices. So if Iran comes off, they'll find some more oil around. It might be at a higher level, right? That it might be $120 a barrel or some higher level, but the supply and demand will balance at some point. So yeah, I mean, it might be different this time. I mean, that's always the most dangerous thing to say in finance, but geopolitical events, generally speaking, are short-term in nature, and I don't make commodity buy or sell decisions based upon geopolitical events.
Well, gas prices in the U.S. this month, this is a trade from Kalshi. It's a prediction market, and I think traders are predicting that there's a higher than lower chance that prices will rise, although just modestly, above $3.5 a gallon, I believe is the bet here, trade rather. So we have here a scenario in which geopolitical tensions have erupted, but at the same time, fundamentals are more important, you said. So I think investors and I think the average American and a Canadian watching this is probably just mostly concerned about how their gas prices will change going forward. Iran or no Iran situation. What do you think?
Yeah, I remember in 1979, when the revolution happened in Iran, that pushed up energy prices dramatically and caused a recession. If it's sustained, energy prices go up. Almost all big recessions have been caused by a surge in energy prices, because it slows down economic growth. So this is sustained and it goes up and stays up for a long time. It's going to severely impact the economy. That's for sure. So it might be the pin that pricks the bubble. So, that's why, in our portfolios, we have negative beta kind of hedge funds that make money when the market goes down, just as an insurance policy. And I think that's important, because by the time you figure out that high energy prices are hurting the economy, the stock market's already going to be down a lot. It's already too late, right? So you just got to start preparing for that in advance. So we'll see what happens if this continues to go and energy prices go up. That's what happened in 2007, right? Up in 2008, we got to $120 oil in June, caused a big economic downturn, right? So energy prices are important. They're more important probably than anything else, and because people cut back if the prices go up dramatically.
West Texas Intermediate is still at $74. Now, is there a scenario in which you see oil coming down?
Yeah, I mean, right. If things kind of settle down in Iran and Strait of Hormuz isn't impacted, oil prices will come down, right? Because the tourists will get out, they'll come down and things will stabilize. But I do think that energy companies, just like mining companies, because the last 10 years have been so brutal, basically. I mean, oil was 120 in 2008, right? It was over 100 in 2014. So we're over a decade here of not good oil prices, really. And because of that, people haven't invested in the sector, right? And that's the great thing about commodities. If you can find a sector where people haven't invested in the sector to increase their reserves, to increase what they're pumping out of the ground, or increase their mining capacity, it's something that is like a rubber band. You stretch it far enough, it's gonna come back. And I think that's what's happening in energy. We've talked about, AI is a big topic, right? I think the way to make money in AI is energy, right? Because 2 years ago nobody was talking about this. More people are talking about it now. But natural gas, nuclear, even carbon-based energy is the way to do it. That's how you're going to increase the amount of capacity for AI.
Bob, let's talk about what's finally next for gold and silver and the commodities overall. Just markets at large. I want to draw the audience's attention to actually a book that you wrote. This is you actually interviewed Canada's top traders. Top traders in Canada, following on, I believe the model was following the footsteps of Jack Schwager. But this is the book. It's called Stock Market Superstars, Secrets of Canada's Top Stock Pickers. I encourage people to check it out. You've had a lot of good conversations. What would Canada's top stock pickers do in this current environment after something like gold and silver, copper have already run up to all-time highs? What have they typically done in the past when faced with a scenario in which a security or a commodity, whatever it is that they're looking at, just ran up parabolically?
Right. Well, I tried to pick managers in that book that, weren't all commodity people or weren't all sector specific, because if you're sector specific, it's going to be a big problem. So you want to be a generalist, right? So you're going to be, easing out of a sector when everybody's going into that sector. Rohit Segal in the book, for example, Rohit's retired now, made a lot of money in the commodity sector, but he also made a lot of money in bank stocks and technology and other areas. So I think a lot of these successful growth managers are going to be good at rotating to new sectors, maybe that other people aren't in. Other managers are in that book are buy and hold people who love to buy things that are hated, right? And if you buy something that's hated, universally hated, generally speaking, you have a margin of safety in that. So I've kind of combined what some of the managers did in that book versus some of the other managers. And in the commodity space, I love the commodity space because it's very, very volatile. Eric Sprott mentioned in the book, he said the reason he loves mining is because the highs are so high and the lows are so low. And the difference between the two is 1,000%. No other sector where you get that sort of volatility. So if you can buy anywhere near the low and anywhere near the top, you don't have to pick the top, you're going to do extremely, extremely well. So I like to look at the commodities and find a commodity where the cost of production is far higher than the underlying commodity, right? Because that's a situation that's not going to last too long. That's a very universally hated sector. That was uranium, that was silver. And maybe that's energy right now. Although I would have loved for energy stocks to go down into the 30s or 40s, that would have been amazing, but didn't happen yet. And then it's got to catch up, right? So companies catch up, and then the profitability just explodes on the upside from there. So I think that's one of the one of the things that I learned from the book. Eric Sprott mentioned in the book, he said, I like to buy a stock for $1 that's going to cash flow $1 per share in 3 years. And he said, if you can do that, you're going to get a lot of five baggers, etc. So I think that's important. Now, you're never going to be able to buy a stock for $1 that's going to cash flow $1 in 3 years per share, and unless you're kind of looking at the world differently, right? The average analyst out there right now has a target or a price deck of $50 on silver. So the stocks are trading like silver's $50, but if it goes a lot higher, then companies are going to make more money.
So ultimately, where are we in the cycle? And let's close off on your mining clock. What is that, and how do you read that?
Yeah, I think the mining clock is really important to look at, and the reason for that is because it kind of tells you where you are in the cycle by reverse engineering. Because the problem is in mining or any other sector, in AI or technology or Bitcoin or anything, is that people are influenced by the narrative, and the narrative becomes greater and greater and greater the more things go up. And it seems like a more logical conclusion the more things go up. So sentiment increases, etc. But the mining clock is a very quantitative way of kind of looking at where we are in the sector. So basically, the market is telling you, because what's happening in the market is telling you where you are in the sector. So, I don't have to go into all the details here, but 12 o'clock is usually the high, and then you get this absolute collapse in the market. For mining, for example, and it usually bottoms around 3 o'clock. So 3 o'clock probably was 2015, right? Glencore almost went bankrupt, one of the biggest companies in the world. Tech, all these big companies were in desperate trouble. They're reducing, they're decreasing the reserves. They're not making money. They're not cash flowing. They have a lot of debt, etc. So some don't survive, most survive, and they cut back. They cut back dramatically, and they bring their cost of production down. They wipe out $1 billion or $2 billion or $5 billion of the reserves and say these are worth nothing. And when you do that, you bring your cost of production down. That's usually 4 or 5 o'clock. That happened back in 2018, 19. Then you start to get these companies cash flowing, starting to make some money, and people sentiment starting to increase. And the first thing these companies do is they pay down debt because they almost went bankrupt right at the bottom. So they say, we're not going to get ourselves in that position again. So they pay off debt, start to get cash flow positive. So then you start to see the price of the underlying commodities start to go up pretty dramatically. Companies become profitable. and then you start to get new issues of companies that come out. That's kind of where we are right now, and that's why we say we're around 630 probably for mining in general and gold specifically. So what happens at 630? Yeah, people decide that, hey, we've got an old mine here that wasn't profitable, but we're going to restart it, and we're going to do an IPO, and we're going to raise money to get this going. So that starts to happen quite a bit on the market, and we're starting to see that. Then these companies really start to make a lot of money. 9 o'clock, the sentiment gets to be very large. You start to get companies get bought out. Maybe they were worth nothing a few months ago, and they get bought out for $2 billion or $5 billion by the majors because they have so much cash, they don't know what to do with the cash, right? So they start to increase their reserves. Then what happens is you start to see that they paid too much, right? Because there's too much supply. And they've increased, too much demand for the supply, so they start to overpay for what they do. Then the commodity starts to crash right around 11, 12 o'clock, and we get back to the same situation. That's a decade-long process, but I think we're middle innings right now. There's a lot of money's been made in these sectors already, right? A lot of these juniors are up 5, 6, 700%. So we're not at the beginning of the cycle. People are still saying, "Are we in a bull market for commodities?" I can't believe they can even ask that question. I mean, uranium's up. The uranium stocks are up 10 times in the last 5 years. That's called a bull market, right? We've been in a bull market for 5 years. We've been in a bull market for commodities and commodity stocks for a while here. Probably middle innings right now.
Okay, Bob. Excellent talk. We'll follow up next time, but tell us where we can follow your work for now.
Sure. We do something called the Gold Digger every month, and it's 2 pages, but it has lots of links in it because people don't read a lot these days. So if you want the Gold Digger, it's just free. You can go to miningwealth.ca. So miningwealth.ca.
Yeah.
And then you can sign up for it there. And we'll just send it out. And we always talk about topical things about all commodities. And we deal a lot with mining executives. So we talk a lot about, making money as a mining executive and how you shield that money and put it aside in other sectors. So I think that's important, David. Why we've always chatted is that we are generalists. I'm not just invested in mining. I'm a generalist. I'll go buy anything, bonds or tech stocks or whatever the case is outside of the sector. And I think it's important to have that kind of outside view to and looking into the sector.
Okay, well, I appreciate it. We'll put the link down below so you can follow the Gold Digger there and Bob's work. And do check out Bob's book. It's a great read. Thank you so much, Bob. Take care, and we'll speak next time.
Thanks again, David. See you next time.
Thanks for watching. Don't forget to like and subscribe. And don't forget to use my code LIN, LIN, when you sign up to Kalshi. Link down below or scan the QR code here. New users will get $10 when you trade $10. Deposit it straight to your account. Link down below.